Hi, the federal government just announced that they're increasing interest rates on federal direct and federal plus loans, and they're going up big. Here's the first of three ways that you can cope with this much and very unwelcome development. The first way is to actually just minimize borrowing. Talk to your student about what school they're going to and whether or not it's affordable. I know it sounds kind of trite, but it's really true. If there's excessive borrowing, and what I mean by that is if it's above the federal maximum for each year, so $5,500 for freshmen, perhaps that school is not affordable, and by reaching with excessive borrowing, either by parents or by students, may actually be putting the student behind the eight ball in the future. So minimizing that first debt borrowing is really critical. The second way to cope with this is to actually try to find grants or scholarships. MyCollegeCorner.com has a really great scholarship search engine. It's free. Go there and try and find some free money. Every dollar that you get from a scholarship or a grant means probably a dollar less in student loan borrowing. So I think that's a really great way to go about it. And the third way to minimize borrowing is to use the tuition payment plans. Most colleges offer you the opportunity to actually pay over time. So you may pay an upfront fee. A company will then pay the college that amount. Let's say you say we're going to get into a tuition payment plan for $1,000. You'll pay $100 a month over 10 months and have that tuition bill paid and minimizing debt. So look at a less expensive school. I know that's tough, but that's one way to do it. Find grants and scholarships. MyCollegeCorner.com will help you there. And look at those payment plans. I think they are the hidden gems. Here's the second of three ways for you to cope with this unwelcome development. And that's a pretty simple one, which is to pay interest while the student is in school. What I mean by that is for federal unsubsidized loans and for private loans, which parents may be looking at as an alternative to a plus loan, and even the plus loan itself, you have the option to pay interest while the student is in school. And that's a really smart way to minimize the amount that will be owed once the student is out of school. For instance, if you have an unsubsidized loan and you don't pay the interest in school, all of that interest over those 4 years, so freshman borrows $5,500, those interest payments are due. If you don't pay them, they capitalize. And what that means is the interest is actually added on to the $5,500 first borrowed. So 6 months after separation or graduation, when the student starts the repayment period, they're going to owe $5,500 plus all that interest. And that whole total amount then, the student will be paying over time, and interest will accrue on that larger amount. So paying interest in school is a great way to minimize the total cost of college. Now for students, I think the government program is the best deal in town. But for parents, particularly those who are looking at a Parent Plus loan, you might do better. Go and check out some of the options that you'll have in the private credit loan market. There are really two kinds of lenders there. One, state-based agencies, which can offer you lower interest rates because their own funding costs are less. Very technical thing, but they may be able to beat the plus loan rate of 9.08% by 1 or 2 or more percentage points, which is a big savings for you. So I would check those out. Members of the Education Finance Council, you can go to their website. They have a nice list of the lenders state by state, or check the lender, the state-based lender in your state. You may be able to do really well. And also the banks, the credit unions, the finance companies, they have some great programs out there as well. So shop around and you may be able to save a significant amount of money for borrowing for your child's education. I've been talking and writing a lot about private credit loans, but there's one tip, a buyer beware kind of tip that I want to leave with you. And that is when you go to the private credit loan market, either the not-for-profit agencies or the for-profit agencies like the banks, the credit unions, they all have great programs, but just be careful of the variable rate loans. Variable rate loan means that the first rate that you get might increase or decrease as your payment period progresses, literally every month. And sometimes the cap rate, the maximum that the lender can charge you, is very high, 20, 25%, really significant. So look at those variable rate loan programs very carefully. Don't fall in love with the first very low rate that you might see compared to a fixed rate. Think about what could happen over time. Fixed rate loans, on the other hand, once you set that, you get your e-signature on that loan document. That's the rate. That's the payment amount you're going to have until you pay that loan in full. For a lot of parents, it's really good to know that that's what you need to budget going forward. Remember, this could be a 10 plus year commitment. So understanding the difference between variable rate loans and fixed rate loans and what works best for you could be a very significant saving. So check that out. Also check out mycollegecorner.com. There are free resources there, a scholarship search engine, some other information to help you on your journey as you plan and pay for college. Good luck.